Great, wonderful. Welcome back, everybody. My name is Joel Landon. I'm with Heritage IRA, and I'm so excited to be back again this week to share some exciting information about real estate investing. As you are aware, you could be listening to this live right now. We're happy to have you here, or you could be listening to the recording that you just received via email. Either way, we're very excited to have you joining us today. And more importantly, I'm very excited about today's topic and guest. Today, we're going to be talking about how ordinary investors, like all of us, use retirement funds to create passive income through real estate. And today I've got Michael Hoang with us today. Michael, welcome.
Thank you, Joel. I'm so excited to be here.
Yeah, likewise. So am I. Just a little bit about Michael Hoang before we turn the time over to Michael. He's a real estate investor. That's one of the reasons we have him on the show today. He's someone who has achieved financial freedom and walked away from the 9 to 5 grind in just 5 years. I know we're going to hear a little bit about that today, so I'm excited. Michael has bought and sold more than 200 doors of single family and multifamily properties in his 8-year real estate career. He is an expert in the BRRRR method. We're going to talk a lot about that. We're going to distill what that acronym means for those that might not know. He's also an expert in co-living, new construction, private lending, and land home packages. And of course, he is also the host of the Get Wealth podcast. Be sure to go check that out. Hopefully, we'll hear a little bit more about that podcast. But Michael, so happy to have you here. Why don't you take it away and share a little bit about yourself, and we'll go from there.
Thanks, Joel. So, my name is Michael Hong, and if you haven't noticed, I am the white guy with the Asian last name. So, I took my wife's last name when we got married. It's always the first question people ask me whenever I speak and stage publicly. So, I like to get it out of the way immediately of why my last name is Hong. Um, but the reason that real estate is just the only place I want to be now that I'm retired from my 9 to 5 job is I had a job in corporate America. I was a risk and safety manager, and I was traveling the US literally 4 to 5 days a week. So, except for weekends and holidays, I was not here in Houston, Texas, where I'm based. I flew to a different city every week. Okay. And so we grew a company from about 180 million in revenue to 1.1 billion in revenue, went public, and then the proceeds of us going public were not shared the way they were promised to be.
Ouch.
Surprise, surprise. And that's when I learned that you can't get rich from a job. You will not get rich from a job. A job pays your bills. A job puts money into your retirement account, but wealth is generated by owning or loaning on assets. And so while I knew my job was unsustainable and I couldn't create the wealth I wanted to, I started building my real estate career in the background. And in just 5 years, and I probably could have done it a little quicker, but just in 5 years, I retired myself in my 30s. And I just have this wonderful career as a full-time real estate investor now.
That's exciting. No, super happy to hear your insights and how you can get rich outside of a job. And I hope that you'll distill that a little bit more. Also, what a huge bummer to think that you guys built up that business from where you were to where you sold in the billions in revenue and you got nothing for it. So sorry to hear that, but I'm sure you went ahead and reclaimed your dignity and were able to find success outside of that in real estate. So Michael, if you don't mind just kind of taking it away and going deeper into your story, let's start there and share with us your insights.
Yeah, so I started my first deal. Well, first of all, I got paid to buy my first deal. I got a check for $800 at the closing table. Okay. That may not be typical for everybody, but my first deal was a house hack, right? So that's where you buy a 1 to 4 unit or a big house with a lot of bedrooms. You live in one unit or one bedroom, you rent out the others. Not super glamorous. Can't do it if you have a wife and kids, right? Not for everybody, but it's how I started. And I just thought, if it pays off half my mortgage, I can put more money away. But through the miracle of real estate, I was living for free and I had an asset that was appreciating and cash flowing. Um, and as we know, right, real estate goes up in value over time, and then the loan goes down over time as other people pay off the loan for you. And that enabled me to start doing the BRRRR method. And BRRRR stands for buy, rehab, refinance, rent, repeat. And so BRRRR method, especially here in Houston, worked really great when I got started in real estate so many years ago. But every product has a life cycle. So I was off to the races buying single family properties. In fact, this house that I'm in now was one of the properties I originally bought as a rental, and we moved into it. And I didn't move into a home until I had enough cash flow from my single family properties to pay for the mortgage in the house that I'm in right now. So I no longer have roommates. I'm a big boy now. Me and my wife live by ourselves, right? And knowing what I know today, I could have skipped those phases of house hacking, but we didn't know what we didn't know. So back to the product life cycle. Everything has a life cycle, right? I'm sure people have heard about multifamily and how there have been some difficulties in that, or office buildings. It's because they're in a bad part of their life cycle, right? And so I had to change what I was doing in my investment story. I had to change my strategy because interest rates went up, taxes went up, insurance went up, and the houses I used to buy just didn't work anymore. And so I reached a point where um, I learned that almost every guru and every guy on stage was selling some program that maybe they built 12 or 15 years ago, and maybe that program doesn't work anymore, or maybe only a small number of people had success in it. So, I learned how to find niches because the riches are in the niches without listening to the guy on stage, without listening to the guy on YouTube. And I learned how to just go pull county data and just look at where profitable deals were happening. And so I pivoted my strategy. I sold all my single family because they just weren't cash flowing anymore as the market shifted. And I found two niches that work really great right now. And can I go into them, Joel, or do you?
Yeah.
Okay,
Yeah, we
cool.
want to know what they are.
Yeah, yeah. So two things that work right now. One is called land home packages. That's where you buy a piece of land, and I have a dealer's license from a mobile home manufacturer, so I can buy mobile homes at a discount straight from the manufacturer. We put it on. You have to install it the right way. This is not a master class on how to do this. I'm just giving you an overview. But when you install the mobile home the correct way, it qualifies for FHA financing. And as we all know, the largest pool of buyers, of end buyers of real estate, is an FHA buyer, right? Because they can put 3.5% down. And pro tip, you can also give them seller concessions for most of that. And so these deals have huge equity in them. We're talking 70, 80, $90,000 of equity every single time I sell one of these. I know people here in Houston, Texas that are flipping a house to make 30 or 40 grand. The juice is not worth the squeeze for me in that. And for my private lenders who are investing with me through self-directed IRAs, why do you care so much about how much profit I make? Why am I sitting here trying to toot my own horn about that? Because your borrower's profit margin is your margin of safety. That means things can go bad over and over again, and the lender is still going to be made whole at the end. And so if I'm coming to my private lenders and I'm asking for a razor thin deal, that's not a situation you want to be in, right? So you want your borrowers to have big margins in the projects that they're doing and have experience in what they're doing because that's the margin of safety you're investing in. The other thing that works right now that I found is new construction co-living. So everybody's probably heard of pad split or co-living. I'll do a brief overview of what it is. Think of Airbnb, right? Where you take your home and you put it on a platform and vacationers and short-term renters come and rent it. Co-living is the same concept, except people rent by the room. And so, what a lot of people are doing in this space right now is they're buying a house built in the 1960s or 70s. They're buying grandma's house through some direct mail marketing campaign, chopping it up and putting a zillion bedrooms in it. The sewer, the plumbing, the electrical doesn't fit it. Maybe they're in a gray zone, subverting the HOA and the local zoning codes. And they're making really good cash flow. That didn't jive with me. And so I found a way to stay above board, to stay compliant, and to work with the government, who is our partner. Our first partner and our last partner is the government, whether you like it or not, and is do new construction co-living. So we build these 10 bedroom, 10 bathroom new construction homes here in Houston inside the loop in areas where there are no HOA and where you're allowed to have 10 unrelated people living together. And these homes are beautiful. Everyone's got their own private ensuite bathroom. I use professional management. And these things cash flow better, like pound for pound, dollar for dollar, square foot for square foot. These things cash flow way better than apartments, way better than multifamily. And but it's an emerging asset class, and so it takes a little more education for people to understand the asset class. The other cool thing about it is we've worked with the city and the fire department and had them come out and look at it, and the city of Houston loves it so much so that last year they dropped some of their zoning restrictions in order to let this happen. Some cities do want affordable housing. And so while I used to buy these beautiful homes in the suburbs in great school districts. I'm living in one now. Those numbers don't work anymore. What people need is affordable housing. So the two things I've found to solve that I am making big profits on is the mobile home land packages and the new construction co-living, not chopping up grandma's house in gray zones and running from the HOA, but building it where the government wants it, how the government wants it, and with waiting lists for more people that want it, and with pad split corporate calling me saying, How many of these can you build this year? Because we want as many as you can put online."
Interesting, Michael. So that's really unique. You identified, if I could just kind of summarize, you identified that obviously all real estate in each form, because there is a variety, has a life cycle. Not just real estate, really, I guess all asset classes, but in your situation, you recognize that there's a life cycle for real estate and you've got to go find those riches in those niches. You identified the mobile home land packages, which I'd almost like for you to break that down a little bit more. Like, what does it look like? How does an investor get into this? In fact, how does an IRA investor get into something like this? Maybe you could distill that a little bit. And then the fact that, the city of Houston is excited in a way, lowering those zone restrictions about these new construction co-living opportunities. Maybe you could distill that a little bit more and just talk about how an IRA investor could actually get involved.
Sure. So with the mobile home land packages, how an IRA investor gets involved is when I do these, I have private lenders. So people come to me with a self-directed IRA, solo 401k, HSA, whatever account type they have, and they're my private lender. And so we go over the numbers, I show them the sales comps, and they fund the purchase of the land and the purchase order agreement from the manufacturer to build the mobile home, because in order for it to be FHA qualified, they have to be new construction mobile homes moved one time, professionally installed by a mobile home installation licensed installation company. And there's a bunch of other little details we have to follow to make sure we're compliant. So private lenders in their self-directed IRAs can participate in that by being the lender on that. The second part of your question, which is how can someone with a self-directed retirement account participate in the co-living, is that people like me, we need equity partners. So while private lending is like 6 months, 9 months, 12 months, your money's out and you're getting your money back plus your interest. With these co-living, these new construction co-living, there's more juice on them than being a private lender, but your funds are deployed for typically 3 to 5 years. And so for some people that may not be a good fit, but for my private lenders, especially when I was buying lots of houses, the second I wired them the money back to their account, we create a new problem. And their problem is they have a 9 to 5 job. They've got kids they've got to deal with. They've got their own life going on. And they're like, well, now I'm not making interest on my money. When can you have another deal? To the point where I'm paying the wire fee just to take it right back immediately. So with the co-living, that kind of solves that. So your money's out compounding long term, and you're an equity holder in this, which means you're along for the ride. When we build these new construction co-living, they have 130 to $160,000 of equity day one when they're appraised. And as you as an equity holder, you're participating in that. And then they're cash flowing, they're appreciating. And the goal in these things is to hold them for 3 to 5 years. And we say we're going to either sell or refinance them. But it looks to me like what we're going to be able to do is refinance them, get the money back from the original investors, both me and my equity partners, and then continue to retain shares in them, continue to have ownership in them with all your money back, which is it's kind of funny because that was what you were hearing a lot of apartment guys say in 2014, 2015, 2016. They were buying these things at such great deals that they were refinancing their partners out and then retaining equity in the deal, which is like that's like a dream come true. You could never do that in the stock market. Well, we're not in the cycle of real estate for multifamily where you can do that anymore. In fact, that hasn't happened for a number of years, but that's happening in this asset class right now.
That's awesome. I appreciate that, Michael. You know, you've obviously been doing this for a while. I think you mentioned 8 years in real estate. I can only imagine that you've made some mistakes. And again, we're really trying to help our listeners today learn what it's like to be, let's call it an ordinary investor, right? In today's environment. Can you talk a little bit about maybe some of your early mistakes and how our clients, our investors, our audience can learn from it?
Oh, I've got plenty. Uh, um, Number one was underestimating my rehab. And so, for anyone who's lending as a private lender on someone who flips houses, make sure their rehab budget is realistic. I'll give you an example. I bought a bunch of houses and I looked at the roof and said, the roof's fine. The roof will last a few more years. We don't need to redo the roof. Let's just hurry up, get it fixed, get it refinanced, finish the burn method, move on. Same thing with air conditioning units, right? The AC worked fine. HVAC guy came out and serviced it, changed the filters, flushed some lines. He said, hey, this thing's fine. Then what happens is you rent the thing out for a couple of years. Every house that I owned ended up with 130, $150,000 of equity. Well, it comes time because there's a season for everything in real estate. It comes time to slaughter the hog and reap the rewards. And then you realize, oh crap, every house needs an HVAC. Every house needs a roof. And so what I've learned from that today is, and then you end up making far less money than you thought you did on each deal. That 100K of equity is not 100K if you're putting a roof, HVAC, and you're doing cosmetic things before you sell the property. So what I learned from that was if I can't fix everything when I buy it, it's not worth buying, right? You're creating a problem for yourself further down the road. And that's why I really like this new construction world that I'm in, because I've done the old stuff. I've done the junkers, I've done the fixer-uppers, and you can make a lot of money in that in the beginning of your career. But what I love now is the mobile home land packages, right? It's new construction. They bring it out from the factory and they screw it in and bolt it to the ground and attach power, water, and you're good to go. And they already have appliances, and you don't even have to install appliances. It's beautiful. It's way more profit for way less work. And then the new construction co-living. When you build something new from the ground up, you're not going to have problems for like 10 years, maybe more. And not only that, but you're getting a builder's warranty as well. So if minor things go wrong, you're not even paying for it. The builder comes out. I have a great relationship with my builder. They say, "Oh, you're supposed to have a $50 deductible." They're like, "Don't worry about it, Michael. We'll just come out and fix it real quick. Don't even worry about that $50 deductible." When you have a great relationship with your builder, it can't go any further. And so that's allowed me to scale and kind of just focus on generating passive income for me and my investors instead of constantly running around fixing a toilet, fixing a roof leak, trying to patch things and just make it work. And so the lessons for anyone new who's getting started out there, I would say when you're looking at a single family deal or whatever you're looking at, if you can't redo everything in that budget, it's not a good deal. Go find another deal or make a lower offer because you're just creating problems for yourself in the future. And you got to make sure you have reserves for those problems.
Awesome. Well, tell us this, Michael. What has consistently worked in finding or evaluating opportunities in real estate?
Yeah, so what I used to do is send lots of direct mail to single family homes. And that worked when the single family homes did work. But here in Houston, the economics of that have changed. But if you can't underwrite a deal, like consistency for me, what consistently works in finding deals is I don't take anyone else's narrative. I don't listen to anybody on any stage in town or on YouTube or anything. I go and do my own due diligence. I go and underwrite a deal myself. I do the hard work myself before I put my money or my time into it. And so if you don't understand the asset class, how can you understand how much money to put in or if you should put in money at all? And two, if you can't substantiate the claims other people are making, like if you can't just look at you shouldn't just like look at a prospectus or look at an underwriting Excel sheet and be like, yep, looks good to me. I put in $1, I get out $3, looks good to me. Then you're probably not ready to be making the big move of putting your real hard-earned money or retirement money into these deals. So for me, it's just been exercises of underwriting, exercises of always finding deals. And even when what I was doing was working, I was still very acutely aware of that product cycle that I keep bringing up, that nothing lasts forever, trends shift, right? And so even when I was buying these single family homes, I was just acutely aware of like, is this still going to work? Is it time for me to sell? Because I learned that in corporate America about product cycles. So, one, make sure that you understand what the asset is. Two, make sure you know how to verify or substantiate people's claims. And three, understand that it works today and it works tomorrow, but it may not work forever. And if so, what is your plan to get out of that asset and into what is working?
Great. Michael, before I ask you another question to kind of lead into some more content here, I just wanted to open it up to those that are joining us right now live. You're welcome to submit a question. We'll just use the chat box. So you're welcome to go over and navigate at the bottom of your screen there where you can pop open the chat feature. Drop a question in there, drop a comment if you want. We'd love to address your questions, and we might even save some of them for the latter half of our presentation, our lunch and learn here, or maybe we'll address the question right here in the moment. But while we're waiting for you to kind of drum up some questions here, let's get back to it, Michael. I think what you've been sharing has been very insightful, and I want to get a little bit into the investor mindset for those listening right now. And if we have a newer passive investor listening right now, maybe they want to use their IRA, in fact, to invest. Um, what would you say is often misunderstood for that newer investor?
So my experience has shown that you have to look at both the jockey and the horse when you're trying to make an investment, right? But for me, the jockey is more important than the horse. I've been a passive investor. I have done loans out of my self-directed IRA. I've done transactional funding, and I've also been a limited partner or passive investor in multifamily in the past. And I can tell you, a bad operator can make a great deal be terrible. And so it's good to understand how to underwrite. It's good to understand that what the deal can do, right? But if the guy, has a drinking problem and can't show up on the job site and is going through a divorce, then that project is not going to perform to the pro forma. And so I would take a mediocre deal with a great operator before I would take a great deal with a mediocre operator. And so take your time, do your due diligence, understand your operator. I mean, this is the digital age. It takes you guys no time at all. Do research, go look at people's social media, Google their name. It takes most people who are great operators are speaking publicly in cities near you. There's people in whatever city you're in. Get to know them. See if what they preach from stage lines up with their personal life. And always, always, always trust your gut instincts. If you feel something's not right, don't get one-itis. I call it one-itis, where you think this one deal is the deal that we all got to have and we all got to make. If you don't like the operator, if you don't like the deal, just move on to the next one. There's a deal every day. Like don't get one-itis.
Yeah, I'm glad that you brought up one-itis. I used to get that sometimes when, shopping for a vehicle. You get your emotion wrapped up in purchasing a new vehicle, and you think this is the only one that I'm going to find. It's private party. It's got great mileage. The person took care of it, and you're afraid, that you might miss out, or that it might be the right opportunity for you if you don't act. But it almost feels like there's always one around the corner if you skip on that one. So, in a roundabout way, take your time. And it's interesting to hear you say that there are operators out there that, their personal life could actually have a really, really big impact on the outcome of the opportunity. So I'm glad that you put a spotlight on that. This question that I have for you kind of bleeds into, a little bit of what you were just sharing, but in terms of opportunity, you've got investors that are in front of opportunities. They might be receiving the email communications, about opportunity A, B, and C, and they're coming from, a variety of different operators. What makes a deal worth serious attention versus those that get ignored?
Well, deals that make sense. Number one, deals that you can understand, that you can see the outcome. If you need like, trigonometry and geometry and you have to take a physics course to understand how the operator says we're going to get to our return. Um, Even if he's
Red
right,
flag.
it's probably not the deal for you. So does the deal make sense? And if not, can you get to the point where it does make sense? Two, does it does the deal have value the day you buy it? What I mean by that is if something's worth $10, am I paying 12 for it because someone told me it'll be worth 15, right? Or is the asset worth $10 and I'm buying it for 8 and I know I can take it to 15? That's kind of how I look at it because if I'm trying to speculate, baby, I'll just stay in the stock market. That's speculator heaven, right? I mean, these companies, what they're selling on their multiples, they've got something that's worth $10, but because of hype in the market and funding and yada 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 and AI, they've got an asset worth $10. They're trying to sell you for 50 or 75 or 100, and then they're telling you, don't worry, it's going to go to 200 because some other schmuck is going to pay more for it. So that was what kind of attracted me to real estate because I may have participated in some of that in corporate America with us going public and the company hype being blown out of the water. And then I understood when I looked at real estate, I was like, wow, here's a house worth 200 grand and I can buy it for 130 and put 20 into it. I'm into it for 150. It's worth 200. Not only that, I know it's going to go up in value over time. The reality is, guys, as long as I keep abusing our monetary system and printing money, these assets are going to go up over time. And so I don't want to pay $12 for a $10 asset, hoping it goes to 15. I want to pay $8 for a $10 asset, knowing it's going to go to 15. And if you're a good operator, you can push the cash flows up to $15. That's kind of what I'm looking for in a deal.
Right on. Well, Michael, I know that we're going to have you on, throughout the year. I think that it's a good idea to bring you on and have you share your wisdom and insights, over time. Maybe we'll have you come on every single month. But
Man, I
no,
would love that.
yeah, I think that would be awesome. And we'll have our investors and our attendees submit some questions ahead of time so we can have some good themes and topics to talk about. But I'm just going to open it up to you, Michael. As we start to get closer to the end of our presentation, let's take some time and just feel free to share insights, ideas, thoughts that you have. Again, knowing that people listening today, they're sitting on IRAs, they're sitting on capital, and they're looking for opportunities to invest. And is the Houston market the right place for them? Is new construction co-living, the right asset class? Maybe, possibly, but would love to just let you take it away and kind of share more thoughts, more insights that you might have that would benefit the listener.
Number one thing is still money doesn't make money. So, as we know, inflation is eating away the value of our money every single day. So, if you have cash sitting in your account, it's okay to have a little bit of cash for an emergency, especially in like a normal checking account. But in your retirement account, that money is supposed to be going to work. It's losing value every single day. If a bank is giving you 2%, inflation's at 6%, you're losing 4%. Okay. So number one is get your money to work, especially in your retirement account. That compound growth doesn't happen when it's sitting in cash. Number two, there is never been a better time to do new construction co-living inside of major metros, especially here in Houston, where the government is partnering with us and opening avenues for us. I also believe that in the next 5 to 7 years, what's going to happen to new construction co-living is what happened to Airbnb in the past. So the person who mentored me on how to build these things, he got into Airbnb in 2014 when nobody knew anything about it. And by 2020, 2021, they had a federal loan program for buying Airbnbs. It's a 15% down second home mortgage that is designed for Airbnbs. By the time that happens, you're at the top of the cycle. It's time to sell. And so the guy who taught me about these, he did Airbnb, first buying them, then fixing them up, like old houses, fixing them up. Then he did new construction Airbnb, and he sold his portfolio in 21 and 22 and 23 when institutional money recognized it as an asset and they started to they change how they valued it from comparable sales to cash flow. They started treating it like a commercial asset. And that's when the value of them 5x'd, right? But that's also when the juice was kind of squeezed out of it. I believe the same thing is going to happen with these new construction Airbnb because right now we're getting great 30-year fixed loans. It's treated like a single family property. It's being valued by comparable sales, so the sales of similar houses, right? And I believe in the next 5, 7, maybe 8, 9 years, it's going to get recognized as a commercial asset class. And what that means is the value is going to go through the roof because hedge funds can now buy it. There's going to be hedge funds that are going to pop up saying we only invest in co-living. What that's also going to mean is the new projects that you undertake once it's changed to a commercial asset is not going to have the juice that they have in them now. You're not going to see the returns that we're seeing. I have a project in Houston that's a 41% cash on cash return for me
Oh,
because I have all of my own cash in it. I don't have any partners in that one, right? Multifamily can't do that. No other asset class I'm aware of can do that right now, but that's not going to be there forever, right? In 5 years, the jig is going to be up, the value of the land is going to go up, the cost to build is going to go up. The lenders aren't going to give us 30-year fixed loans anymore, right? They're going to say, oh, this is a commercial asset. We'll give you a 3, 5, or 7-year adjustable rate mortgages like we do on multifamily and self storage, right? So that opportunity is there right now, and it may be there for the next 3, 5, 7 years. And so the guy who taught me about this went through this cycle with Airbnb where he built it up, the hype came in, he sold when the hype came in, and then he discovered this. And he's like, Michael, build as many of these as you can right now. The government loves it. Nobody knows about it. We're going to build tons of these things. And then when the hype comes in, he said, don't get one itis. Sell it, let it go. You and all your investors can leave on a great multiple, and then we'll find the next thing, And so to the gains that are possible in the next 5 years with new construction co-living is insane. But then when you factor in that you can do it tax-free in your self-directed IRA as an equity partner, that's just something that the stock market or a W-2 job could never do for you.
excellent. I appreciate that wisdom and almost insight into the future just based on the experiences you've had and what happened with Airbnb. So I appreciate that insight. It reminds me of the Seinfeld episode, leave on a high note, right? And so that insight could be really beneficial for the investor that's, exploring this asset class. If anybody wanted to get hooked up with you, Michael, just for maybe one-on-one or even, wanted to follow you, what could they do? What kind of insights can you share with them?
Yeah. So if anybody wants to reach me, you can find me on social media at Michael B. Someone. DM me on Instagram. I get back to you the same day. And because no one has abused it yet, I do give out my phone number when I do these things. The second someone abuses it, we'll have to stop doing that. But text me, don't call me because I get spam phone calls just like you guys do. So if you call me, I won't answer. But my number is 832-301-9672. Text me any questions that you have. And also, if you want to look at what I'm doing and more little golden nuggets, follow my Instagram at Michael B. Someone.
Michael, we're going to have you on next month if that's okay with you.
I'd love it. I'll clear my calendar, Joel. I'll be here every
Cool.
month.
Right on. Yeah, we'll be sure to ask our clients some questions to come prepared with some of those, and you can share and answer those for them. But we appreciate everybody that's taken the time to join us live. We hope that you found some value. I certainly did in what Michael shared with us today. And those that listen to the recording, thank you. Thank you for taking some time out of your day to do that. Be sure to reach out to him. He gave you his cell phone number. That's rare. So give him a phone call, shoot him a text, have a great conversation with him. And Michael, thank you again for joining us, and we'll talk to everybody later.
Yeah. See you guys soon.
Thanks.